Just about. All right. Greg, welcome to the Magic Internet Money Podcast. Thanks for taking the time to join me and discuss all about model airplanes. And
what a pleasure. It's been a while. It's been a while coming, hasn't
it? Yeah, about a year, I think.
We've been involved in various things, and this is the first time I've seen you. I've seen you live with other podcasts, but the first time I'm talking to you live.
Yeah, good to see you.
Thank you. You too.
So, yeah, you've been in the Bitcoin world on Twitter and stuff for the last year and a half, 2 years, I think it is. Okay. And I started seeing you pop up on my notifications and stuff when you were talking about the QBTC product, which was the first regulated fund that was put onto a major stock exchange, and you were instrumental in like investing in that in the early days. And we're kind of helping get awareness out of the QBTC fund, and that thing has ended up taken off and doing really well. And I'm sure a lot of people have protected themselves with the QBTC product. So thanks for your efforts there.
And you too. I'm assuming that most of your listeners know that you're a shareholder in 3IQ as well.
I don't talk about it too much. I did one episode about it with Mike in Space. Me and Mike interviewed Fred about it. But since then, I think they're up to like 2 billion under management right now.
It's big,
something like
no
that.
question. Yeah, but they definitely it took the world by storm. I'm proud to be part of it, as you should be. Here's what I know. I think they've probably, let's just say if it's 2 billion, let's just look at the Bitcoin product. It's easier for me to analyze. They got about 1.3 billion in Bitcoin. And I'm guessing of that, at least half of it, if not more, let's say $700 million is probably capital gains that the fund has made for Canadians. So that's an outstanding achievement, and very proud to have been part of that. And my hat goes off to the team.
So for people that are listening that maybe don't know what QBTC is or don't understand the significance of Bitcoin entering the regulated markets, do you want to kind of give, if an average Canadian person is listening, like what's the value of paying attention to something like QBTC versus buying Bitcoin?
Sure. Well, in my case, so we'll take a few years back. I was approached by Fred Pai, CEO of 3IQ, in 2016, where he had an idea that Canada could be a great candidate for a regulated Bitcoin closed-end fund. And what that would require was approval from the Ontario Securities Commission. And
can you just explain like what a closed-end fund is versus?
Yep. So the closed-end fund is a precursor to the more popular exchange-traded fund ETF. The closed-end fund is a product that follows its moniker a little bit. It's closed. It's generally closed to investment, and the price of that fund is set by the open market. So while the fund will have a net asset value of Bitcoin, in this case, 100% Bitcoin, the price of that share is determined by the market. Even though the net asset value of that share may be $10, if there's extreme demand in the market to get exposure, that price may increase and trade at a premium. And the flip side is sometimes it'll also trade at a discount. That they can provide opportunities. It can provide some heartache for some people, but the closed-end fund was initially the proposal because we didn't feel that the regulators would be receptive to an ETF right out of the gate, since there would always be concerns about market liquidity, the size and depth of the market to be able to operate an ETF. Okay, go ahead. Sorry.
So just like for, I guess, first principles or easy, like noob thinking or whatever, if somebody wants to buy Bitcoin, but they've got a TFSA or an RSP or even a Roth IRA or 401k or whatever, some kind of like regulated retirement account where you get tax benefits.
Yes.
You can't buy Bitcoin and put it in there. So 3IQ was a way to have a paper version of Bitcoin, which kind of is antithetical to the ethos of Bitcoin. Don't trust, verify.
Some of them for sure.
But a lot of people just want price exposure because they believe in the asset, but they they wanted to be able to get like gamble on, basically bet on the price of Bitcoin going up in their regulated tax deferred and tax efficient accounts. And there's like two ways to do it. As you're saying, there was an ETF and then there's a closed end regulated fund.
Correct. The ETF did come afterwards. It was the big one is offered by Purpose, Sam Seif's fund. It's a great product as well. But here's the interesting thing, and I think this is really important, Brad, that the ability to invest in a tax deferred account on a tax deferred basis, i.e., the government will pay you or redeem some of your taxes if you do it in a TFSA. If you, as you know, put some money into that account on an annual basis, the government will give you a refund. Well, let's just say you were starting with zero exposure to Bitcoin and you decided you were going to put $10,000 into Bitcoin and you were going to do it in this year's RRSP version. You can do the math and realize that, you can either buy more Bitcoin. So you can move it up from 10,000 to 15,000 because on an after-tax basis, you will get some money back, or you can just buy 10,000 and expect a tax refund. This is good for Canadians. It's also good for your ability to shield any taxable capital gains. Most importantly, though, most of the money in the world, as you know, certainly in people of my age, exists in brokerage accounts. And you like to be able to buy and sell things as easily as you can buy and sell common stocks, bonds for certain. And this is why it would be very appealing to people of my generation. You said, well, some people, not your keys, not your Bitcoin. That's true, but that falls on deaf ears for people that are my age. That really prefer to see everything in one spot, right? You want to see what your stocks are. You want to see what your bond exposure is. You want to see what your Bitcoin exposure is. It really lines up nicely rather than holding one on in cold storage in a safe where you have to remember your keys. All this is cool, and I encourage people to understand what that means. But when it comes right down to supply and demand of money, most of it exists in supply and demand of savings. Most of it exists in brokerage accounts or the like.
Right. So you actually had a really interesting line of thinking around this back a year ago. I think I saw you tweet about how if you put your retirement account, whether it's RRSP or I think it's the Roth IRA, into a Bitcoin product, the government is actually subsidizing your purchasing of Bitcoin because you lower your taxes and get a tax rebate back, and then you can just buy Bitcoin with that. And basically, the government's giving you some free Bitcoin.
Well, it applies on every basis. Like that's the same thing for getting people involved in stocks in general, right? This was a big, when I started in the markets in 1986. I mean, the RRSPs were not a common investment vehicle. If memory serves, they may not even have existed back then, and this is how people get the ownership of common stocks or commodities or or crypto or Bitcoin, as I like to focus on. It's an on-ramp for people to become more comfortable, and certainly the government wants you to do it because they realize that they do not have enough money to pay people or to support the population based on their pensions that they're saving for people. They need people to save for themselves. And this is what, this was Fred's idea, get an opportunity. Now, the interesting thing about Fred Pye is that he started the same thing with gold.
Oh, yeah.
Back in the day. Yeah. So Fred was involved in the first listing of a gold traded closed-end fund. And the link is, well, this is, some people, I don't happen to think of Bitcoin as digital gold per se. I don't argue with that analogy, but he wanted to take physical gold, which he did the first time, and swap that as digital gold and offer that to the Canadian investing public. And thanks to a gentleman by the name of Sean Cumby, who was the CIO of 3IQ, they took this OSC to court and won. Which was people would give you about a 1% chance of that happening.
I didn't think that they were going to win. Like the OSC, for people who don't know, it's the Ontario Securities Commission. They're basically like the SEC of Canada, and they were not wanting to allow the Bitcoin fund to go forward, just like the SEC has been denying the Bitcoin ETFs in the United States. I just wrote it off too. I was like, oh, well, I'm really supportive of 3iQ trying to do that, but I don't think they have any chance of actually winning the case against the OSC, because what incentive does the OSC, this traditional incumbent, have to allow people to enter into this new financial system and do it in a way that's like optimized for taxes?
Sure.
It's like the incentives were all skewed, so I figured it wasn't going to happen.
But as did most people after we had some certainly some speed bumps. But here's the good thing: hindsight always being 2020. You look back on it, and on behalf of Canadians, that decision has allowed Canadians, RRSPs, and TFSAs to an extent accumulate more than $700 million of mark-to-market wealth. Okay, you can't argue with that. Now, to the benefit of the gentleman who was made the decision, the moderator, he basically said, look, it's not the job of the OSC to decide upon the risk parameters of the investment, or the risk parameters, or the risk attributes of the investment. The only job of the OSC is to ensure that it can be properly regulated, to ensure there is not market shenanigans going on. And to his benefit, he ruled in favor of 3iQ and the product that 3iQ was bringing to the market, as ticking all the boxes, as yes, it's not manipulating a market, it's not trying to defraud investors. Yes, it is in a risky asset, there's no question, but they allowed it. And Canada came first out of the box in a regulated exchange. They have it in the US. It's called Grayscale, but it's not on a regulated stock exchange. Grayscale trades on the pink sheets in the USA, and a lot of institutional accounts cannot own a stock that trades on the pinks. Okay, so this was really a landmark decision. So healthy.
Pink sheets is penny stocks, right?
Pink sheets, it can be areas where defaulted securities have gone. They don't meet listing requirements on for other exchanges like the New York Stock Exchange or NASDAQ or whatever. And you're right.
Like Wolf of Wall Street was all about the pink sheets.
Sometimes, yeah, a little bit. You know, they were called boiler room. Okay, but some of them now, GBTC. Let's give respect where respect is due. GBTC is a $30 billion. $30 billion. Are you telling me that that's not big enough to be on a regulated stock? And this is why the likelihood is in the US, in the foreseeable future, they will accept an ETF. There's no question about that. But what did Canada do? Well, Canada jumped ahead. They said, okay, we'll allow this closed-end fund. And then very shortly thereafter, they approved an ETF, which is an even more efficient way of getting exposure to Bitcoin.
So the main differences, before we move on to a different topic, I guess, of a closed-end fund and an ETF, is that just like the paper gold, you know, quote unquote paper gold, which is like you can't put gold in your retirement account. So these companies created closed-end funds and ETFs for gold, which the shares of the fund back a certain net asset value of the gold that they've got in their vaults, or that they have legal ownership to. So there's no mechanism to just peg 1-to-1 the value of gold to the value of the share based on the net asset value. It's up to the free market and the traders who are making markets and people buying and selling that to make sure that there's no discount or premium on that price to what's actually underlying the
not
thing.
Make sure, though, remember, not that no one can make sure. They can certainly try and take advantage of it. Sometimes the market is, and usually the case is, the market is bigger than the individual trying to arb that, no question. But the good thing is, when you have an ETF, there is what's called a creation and redemption feature that takes place every single day that ensures that the ETF will trade at the market close to the net asset value of the fund, not just close, like right on top of it. And
so that allows people to arbitrage it way quicker to get the price.
Not even arbit. It doesn't even arbit. It's a creation redemption function that makes sure that the value in the Bitcoin fund at the end of the day equals the amount of money that's been raised from the market for that fund. Okay, so again, a closed-end fund, you might be able to raise, let's say you raised $100. in the closed-end fund, it may trade at $150 only because there's more people that want to buy it, but they haven't reopened it to grow the size of the fund. The ETF will grow and shrink every single day at 4 p.m. according to what the flows of the market were during that day.
So it's way more efficient at pricing it.
That's the best way to look at it. More efficient, and actually has lower fees as well. So the tracking should be better. The fees should be lower. Over time, it is a good investment vehicle. There are still some attributes of the closed-end fund that apply. And by the way, if the closed-end funds, which at the time were trading at a premium, now were to begin trading at a substantial discount, well, you're supposed to go in there and say, at what discount do I buy it so that I can actually take advantage of buying Bitcoin cheaper than I could in the open market myself. If someone's going to give you a 10% discount on clothing at a store, and the clothing is just as good as the clothing at another store, you're likely going to shop at the store that provides the discount, right? And it's the same in the markets.
So there's actually 3 types, right? There's closed-end, which is like what GBTC is, and then there's open-ended, which is what QBTC is, and then there's the most efficient one, which is an ETF.
Without getting too granular, that's fair. There's some subtleties between it.
And the closed-end one, like the GBTC one, that's like what, once every 6 months or something they open it up to?
No, so when it was at a premium, they were able to open it up on a regular basis and issue the stock or the shares to the investing public. It was usually large QIBs, qualified investment. What's it stand for? Institutional buyer, QIB, qualified institutional buyer. They would come in and they would buy it at net asset value and turn around and be able to market overnight to the premium that it was trading at. Now it would have to stay. They could not turn around and trade it. They would have to hold it for a 6-month period.
So okay, so there's some wiggle room with being able to like work on the taking in new funds and helping.
And that's
the
where there was
a
huge trade that was people. Imagine this: you're a hedge fund and you can and something's trading at a 20% net asset value premium to net asset value. Will you buy it at net asset value that day? You lever it. Let's say you lever it 3 times because your prime broker gives you 3 times leverage, and all of a sudden you have 3 times leverage on a 20% net asset value premium. That's a 60% return. That's
not bad.
These are sort of fun trades to put on, right? Until it doesn't work. And a number of factors have contributed to the fact that GBTC, which did trade as high as an 85% premium, now trades on a regular basis at about a 10% discount. It's a $30 billion fund, guys? That's $3 billion of VIG. That's a $3 billion delta. That's exciting stuff to a guy that's in hedge fund business, like going the other way this time though, right? Now, the reason that GBTC may trade at that discount forever, if they don't switch into an ETF, and they said they plan to try and switch into an ETF, but if they don't, one of the reasons they wouldn't is because you can't redeem that fund for Bitcoin. In the case of QBTC, our fund, you can actually get redeemed at either net asset value once a year, or you could actually get Bitcoin as delivery. And that's pretty exciting stuff, right? Because that'll regulate, or not regulate, but that'll balance the market. And some smart person will say, well, yeah, you're going to give me Bitcoin 3 days before the redemption date. I'll buy it at a discount. And then 3 days later, I'll get full net asset value for it. Just, you'll deliver me full net asset value. That's why hedge funds exist.
So for the average sort of retail investor or normal person that's thinking about these things, or doesn't have a lot of time thinking about it, I guess I used to be in that position where I was just an entrepreneur and I was making money, but I wasn't a trader like you or anything like that. I was just making money with my internet business.
Yes.
And I was looking at how do I invest? What should I invest in? And started looking at stocks and ETFs and gold ETFs and stuff. And then the big line of thinking around the time was paper gold is not as good as gold. So if you want to invest in gold, don't put it in the ETFs, don't put it in the mutual funds, because they're manipulating all those markets, and they don't have the amount of gold that backs it because there's no way to know if they actually can redeem for how much value of gold they have.
That's all true. You know, then there's physical gold ETFs, and this is part of the way the market has matured. Right now, it's all of the ETFs that are out there, where the purpose vehicle is 100% physical Bitcoin. Okay, so we'll just compare it right now. If you buy purpose ETF, it's 100% physical Bitcoin. It trades.
Are they doing proof of reserves? Like, can we actually see on the blockchain that they've got it? Or are we having to trust?
Interesting question. I mean, I just, you know, as an ETF that's regulated by the OSC, I can assure you that yes, these are the types of things that the OSC regulates.
See, that's the big thing about the difference between gold or any other commodity and Bitcoin, is that on a blockchain, you don't have to trust, you can verify.
Oh yeah.
Right. So
yeah.
We need to see more of this proof of reserve stuff happen, because that's the whole benefit of a blockchain. It's transparent.
See, this is why I love guys like you. This is why I love guys like you, because yeah, you're 100% correct. And for me, that I always, when I traded for institutions, I always had an operations group that was supportive behind me, that I assumed, and you can never assume, verify, right? Never trust, verify. But this is some of the things that they would do. Taking one step removed, I mean, look at these, look at the problems they've had with their prime brokers in the US right now, where one prime didn't realize that the same account was exposed to multiple different prime brokers and using leverage in the system, which was way higher than they assumed. And I'm talking about the Archegos, you know, call it a, you know, it's a black eye on the U.S. hedge fund community, because, or the prime brokers community, because these operations guys did not do their homework to verify that Archegos did not have exposure to 4 or 5 different prime brokers, and all of a sudden you saw.
I don't know what that is, Archegos. Can you?
Okay, so Archegos was Bill Huang, one of the tigers, trained by Julian Robertson. They had these guys called the Tiger Pups. He was one of the Tiger Pups. He was running a fund called Archegos as a family office. Now, there's a family office definition in the US allows you to sort of fly a little bit under the radar, but he's the guy that had all the exposure to stocks like Discovery Channel, Viacom. He had some Chinese internet companies, and they're the ones that crashed, right? If you look at Viacom,
is that the guy that lost like his whole $2 billion or something?
He was $15 billion, and he turned it into a bagel over because he was using leverage. He had 85% leverage.
Okay, he went from like 1 billion or something to like 15, and then it all blew up.
So yeah, no, that's the one. That's what I'm talking about. But the culprit.
Yeah, how does that relate to the U.S. prime brokers? I didn't.
So the prime brokers are people that provide leverage to the hedge funds, and if the prime broker assumes that counterparty, being Archegos, they can only monitor the leverage that you have one-on-one with them, what you're providing. You don't realize they're doing the same thing with Morgan Stanley, with Goldman Sachs, with CSFB. Who were the guys that were caught, you know, Goldman and Morgan? I love those guys. So everyone went, the guy went to the primes and said, can we work out a solution so everybody is like, you know, and Goldman and Morgan said, screw that. I'm out. I'm blasting this out into the market. And 2 days later, CSFB sitting there, and they're offside $4 billion because they just were slow and they didn't realize the exposure that they had to this counterparty that was liquidating because leverage was being unwound in the system.
And, you know, these things, even though they sound like small amounts of money, they can be the trigger to a whole house of cards.
I promise you that $4 billion is never a small amount of money. and I'll tell you, it does sound small now, unfortunately, because the governments are always throwing around trillions of dollars. But look, Brad, this in normal times, and I'd say when you didn't have central bank shenanigans like I've never seen in my life, because they have never existed like this in my life. 10 years ago, this would have destroyed the markets. They would have been off 15% globally just because. And now
it did happen with LTCM back in like the 2000s.
So there you go. And that's exactly. And you know how much LTCM lost? $4 billion.
Yeah,
Isn't it funny? Isn't
like,
it funny? Now, they were using a huge amount of leverage as well, and they needed to be bailed out by Wall Street. The guys that were buying protection from LTCM were all the investment banks that had to bail them out, because LTCM didn't do their math properly, but also Wall Street, they had $4 billion of capital, but they had like $80 billion of loan or of exposure against that capital.
It's like derivative risk, right?
Yeah, exactly.
So for people who don't know that story, there's a great book, Currency Wars by James Rickards, and he talks about he was the chief financial officer, I think, or the lead accountant or something for LTCM.
Okay.
And he begins the book talking about his experience with LTCM and what really happened behind the scenes, and their meeting with the Fed and the prime brokers. And his theory was that, I mean, he talks about a lot of other things. He gets on to like the more global macro fights between countries trying to retain dominance of currencies and devalue each other against each other's currencies to get the upper hand in GDP growth and all that. So he said that it was Lehman Brothers that was like not coming to the table to rescue LTCM. And so in 2008, when the real estate bubble blew up,
so they penalized Lehman at that time. It could be. Here's the neat thing I'll say.
All the other ones they let.
So I've not read Jim Rickards' book. I did read another great book. It's called When Genius Failed. Okay, it's the same thing. It's the story of long-term capital management. Now here's the thing that stuck with me. And as you know, like, I'm a big believer in mathematics, and that math is the base layer of language, and everybody understands math regardless of what language you speak. You understand math. It's a universal language. So math was that they had Myron Scholes at LTCM, long-term capital management, as a Nobel Prize winner, and he was selling volatility to the street. Okay, that was their whole thing. They were selling vol, which meant they were selling protection. And when things blow up, as you guys know, the VIX goes from 13% to like 85%. Well, if you've sold stuff at 13% and then at 20%, then at 25%, and it's trading at 85%, you're getting destroyed. And that's exactly what happened to long-term capital. They go, I don't understand this. It's trading at 99% confidence interval, meaning they've never seen this before. And they based that whole thing on 6 years worth of data, Brad. 6 years. If you're a Nobel Prize winner, do you base an entire business on 6 years of data? You can't set that up, but they did. And this is how foolish sometimes these things that you think people are academics and the smartest people in the room, they're not that smart. Okay. And this is exactly what happens in the market. So yes, great book, When Genius Failed. Boy, did it ever fail. And it was my second experience of the Fed bailing out or socializing losses amongst big players on the street so that the system could continue. The leverage in the system could continue.
The more that you learn about, at least for me anyways, not being an insider or working in the financial industry, the more that I learn about how the economy is actually run, and I'm just appalled by what the financial markets are. It really is just a big giant casino for whales. Like that thing you were talking about, the VIX. Okay. It makes absolutely no sense. It's just a big Ponzi scheme, basically. Like,
well, no, it's only math. The VIX is based off of option. It's based off of option prices.
I know, but when you get rid of all that stuff, you just think of this as a regular person.
Yes.
The VIX was like the number one thing that was driving all trade in the last couple of years. It was like where everybody was going.
It's a measure of risk. It's always a measure of risk. Okay, so
it's the volatility index, right?
That's exactly what it is.
Yeah. It's just a bet on how volatile things are. It's not actually anything fundamental. It's nothing real.
It's just math.
But it's like it doesn't do anything productive for society.
Oh, it sure does. Oh, yes, sir, it does. I'm going to take the other side of that trade.
You can't own volatility though. You can't like plant volatility.
You want to bet. You know what credit is? If you are long credit, you are implicitly short vol. Okay, that is a base consideration of if you are a credit investor. And if you need to hedge as a credit investor, what do? You run and buy some vol.
What does that mean to be long credit? I don't know what that means.
Okay, so let's say you own a high yield bond fund. Let's say you're a high yield bond trader, like I spent 30 years of my life being. I'm generally long in my book, which means I'm long credit, and de facto, I am short vol. So when things start blowing up in the markets, the first thing I do is run to the options market and I purchase some vol, because it's called hedging.
But that's hedging, but that's basically just putting it all on black, or
Oh,
like
sir, no. It's hedging. It's not betting. It's hedging, because you're already long something.
If you got the roulette wheel spinning
No,
over
sir.
here, and
No, sir, Brad. I'm going to take
conservative bets.
This is why you need to understand that it is actually a very valuable instrument in the market. It is what everyone was running to long-term capital for protection, because they were long all these other instruments and therefore needed to be purchasing protection or purchasing volatility. Over time, vol always declines until it hits the wall and it explodes. And that's, excuse me, just the way financial markets work.
Well, that's what happened last year in the COVID
all the
crash.
time.
The volatility index went like crazy.
Absolutely. But look, over time, you'll see it. You'll see it in 1988. You'll see it in 2000 when long-term capital blew up. You'll see it in 2007, 2008. It was all about volatility. Because what is vol, you guys? What is vol? It's a measure of risk. That's all it is. So if it's a measure of risk and you're a risk trader, you better understand what vol does as your ability to hedge the risks that you have in your portfolio.
Yeah, but like, I'm coming at this from a fundamental sort of like perspective that's divorced from like the financial markets. I'm coming in at this from as like a normal person. I grew up on the east coast of Canada.
I love you, but you're going to say fundamentals, and I'm going to tell you that fundamentals don't mean squat when you need to raise money. Okay, if you're being redeemed, if you manage a big fund and your unit holders are telling you, "I want cash back," you can hold this piece of paper you own up to Wall Street and say, this should be trading at 8 times earnings. It's got enterprise value to EBITDA of this. And Wall Street will say, go pound sand, Foss. I'm only bidding you this right now because everybody else in the world's a seller as well. And you can hold up all these fundamentals, Brad, and they'll just say, the market is what the market is. Okay. And that's what happens. You get redeemed when you least want to get redeemed. That's when your unit holders are redeeming from you. And when you don't want their money, that's when they're throwing all your money at you. That's the way psychology and markets work.
So what I'm saying, I think, is a little different. I'm saying that.
Sorry. Yeah.
I think that what you're hedging against, like when you're buying VIX and you're hedging against the other markets, I think that in itself also is a bit of a scam, and it doesn't provide anything valuable to society. It's just another room in the casino.
Okay. Or what about if you were able to show returns that are, by hedging, your returns are much more smooth. You've actually put up better risk reward numbers than the competition at lower vol, at a better Sharpe ratio, all these things that go into calculating whether you're a good money manager or a good hedge fund manager. I mean, unfortunately, that's how the scorecard lines up, and VIX is a very important component of that consideration.
So here's what I think makes sense. The more I learn about the markets and stuff, initially I thought futures was a giant casino, and then I learned a little bit about like how when it was created initially, it was to help farmers and producers of things hedge the risk.
Yes.
And then I thought, okay, well, that makes sense. But then if you look at actually what the amount of volume in the future market is, it's just gambling. It's not actually farmers like hedging their crops.
How about we say the same, but no, okay, it's not just, you're right, but the most important component of it is the farmers that do. That allow them to do that. Yes, 100%. And I'll say the same thing. Let's take it to the currency markets, and then we'll even expose a bigger, the fiat currency markets, trade 30 times the value of global trade. Now, tell me that global trade
doesn't make any sense.
Except, what is the base fundamental of a cross currency transaction? It is for somebody who is selling a product from one country with a denomination in a currency that needs to get delivery in another country. Okay, that's value. Now, the fact that there's 30 times the amount of currency trading globally versus global trade, Yes, you're darn right. And don't you think the banks make, or they think they make a ton of money on that? They actually don't, but they need all these traders who are going to rape retail. When you go to the bank and you're captive to TD Bank, okay? You go to TD Bank and you need to do a cross-currency transaction. You're not comparing rates as a retail guy between TD and Royal. You're in their office and they have you. And that 2% bid offer spread in foreign exchange, you're their monkey and they're going to rape you every single time. But in order for them to be able to provide that service, or call it a service, they need to be participants in this other global market of foreign currency trading.
Yeah, I mean, I think if you just look at like derivatives and the history of how much notional exposure it's gone into the hundreds of trillions, if not quadrillions.
Yeah, quadrillions.
And like some people say, the quadrillions number is a bit of is like a huge stretch, because there's a difference between the realized value and the notional value, which I still
notional
don't really
versus
get.
Net. Well, notional means how much are out there in total, and the net is the exposure if you take longs against shorts. You know, and generally most derivatives net out to a substantially lower and very substantially lower amount than the notional,
which is still pretty huge. Like the net value is still massive. And if there was a sort of match that started off the fire, and we did see a collapse of the global derivatives markets as banks stopped lending to each other and start to go bankrupt, it would probably be in the at least mid tens of trillions.
Oh yeah, it always is. It's just like 2007, 2008, 2009. Where did it start? It started in the structured product derivatives market, the alchemy of pretending that something is a AAA credit rating when it's not even close.
Which is just another, that's the pit in the casino, right? It's like the we'll give you some chips. We'll give you some chips. You're worthy.
Okay. Here's the great thing. Okay. For an East Coaster, and I will say for anyone who's listening to this that is not from Canada, doesn't understand what Brad's saying when he's an East Coaster, the simplicity of the East Coast mentality is beautiful. And you're absolutely 100% correct, except this, okay? When I say accept, I don't mean accept, I mean accept. The exception is, and this is really important, okay? The exception to this casino is, it's always a measure of risk return. It's not a casino if you believe that you understand the numbers. And there's lots of hedge funds out there that will tell you forever and ever that they don't make bets. They take calculated risks. Is there really a difference? No. For an East Coaster, they're both bets. But when you go to a casino, the house always wins. The house is biased to winning at a casino versus financial markets. There's no house. It's a zero-sum game. There'll be a guy that wins and a guy that loses.
Except now there's a house. It's the central banks.
Okay, it's not a house. What that is a backstop. Yeah, that's, you call it a house. It's not even. It's pathetic. It's,
well, actually, the GSIBs, the globally systemic important banks, they're pretty much the house now because they're too big to fail.
Okay, I'll accept that.
And the backstop is the central banks.
Fair enough, and it always ends up with the central banks. So
when we go back to like say 100 years ago, right, when the markets were just starting out, there was no derivatives or anything that.
No,
it made sense from the average person's perspective that there would be a market where companies can issue their shares, and then you can go long on those shares, or you can short the shares if you think that the market's overheated. So buying and selling makes sense. Short selling, naked shorting is something that was kind of introduced later.
It should be illegal, and in most cases it is, except for very specific situations. Yes,
but it's like that's the fundamental sort of thing I was talking about before. Like fundamentally, it makes sense to me that you can buy and sell company stock.
Yes,
and then maybe you can do commodities and like cattle and orange juice and things like that to hedge against the economies getting wrecked of, say, like a famine or a drought or something like that. But then when you start layering on all these risk products and all these derivatives, that's when it seems like it's been taken over by gamblers and casino owners rather than like people that are contributing to society in some useful way. And I'm not trying to be, I'm not trying to shit on you, man.
No. Listen, look, I participated in this, in this environment, and my opinion, and this is somewhat biased, is there are artificial regulations or artificial restraints in a lot of markets. And what derivatives allow you to do is actually break down some of those artificial restraints. And I'm just going to give you a classic example. All right. Did you know that Ted Rogers, our famous Canadian entrepreneur, because you're an entrepreneur, he started a cable and wireless plant called Rogers Communications that was the global standard in Canada for quality of cable and wireless plant, okay? Now, he used a whole lot of borrowed money to do that, to the extent that he was actually at one point the largest high yield borrower in the world, Brad, not in Canada. Wow. Ted Rogers was the largest high yield borrower in the world. This is funny, coming out of a Canadian company that goes to New York and raises high yield debt at a fixed rate, being the largest borrower in the world. It's some sort of a source of pride, except if you're Canadian, because, you know, you see in a newspaper, they write, Ted Rogers has more debt than the province of Prince Edward Island. Now that's true, except Ted Rogers also had more cash flow than the province of Prince Edward Island. It doesn't mean that it was a bad thing that he had all that debt. But here's where I'm going with this. There were Canadians that would not buy his high yield bonds because they were called junk bonds, but they would buy the equity, which is a subordinate claim in the capital structure of Rogers Communications, because it was in the TSX 60. Okay. There was one account that I was dealing with, was when I was on the sell side, that owned $900 million worth of Rogers Communications common stock, and they would not buy the senior claim in the capital structure called the debt, because the debt was a junk bond.
But wouldn't you, if you're buying the debt, aren't you on a fixed return? But if you're buying the equity, that could triple, let's say.
All true. But what if the debt is not worth 100 cents on the dollar? What's the equity worth?
Probably
zero.
Way less. Yeah.
No, not way less. Zero. I'll tell you, it's worth zero. Okay. So the funny thing is, these clowns said, I own $900 million of this equity, which is not a contract. They would not buy the bonds at any price, meaning any yield.
Bitcoin Tina says many investors are stupid.
Thank you, Bitcoin Tina. You know, Rich, I thank you for calling or listening in. Yes. Investors are stupid. They're biased. They are set on different things. So I'll just go back, and Tina used to trade credit default swaps, so he understands.
Let's not dox him too much. I don't know if he wants any of his information out, but continue.
I guess. Well, I just sometimes, here's the thing. He used to trade credit, if I'm not mistaken. It doesn't really matter, and I'm not even sure what the word dox means, but I'll look it up. I know what it means, so I shouldn't betray his confidentiality.
Yeah, what it comes down to, he's got a brand of being an anonymous
guy. So good man, smart guy. Here's what I'll tell him.
A Bitcoiner.
Here's what I'll say. Did it make sense that account that owned $900 million did not buy Rogers Communications debt at a yield of 12%, treat the coupon on the debt like the dividend they weren't getting on the common stock, trade up in the capital structure, not on all of it, but just on a portion, okay, reduce risk, own a junk bond, and have a blended or a hybrid exposure to Rogers Communication.
Okay, so we'll add that onto the stack. Okay, that makes some sense. If you got bonds which represent
senior claim,
a claim on
the assets, first claim on the assets versus the equity.
So they're borrowing money. You're going to get an interest rate back. Correct. As long as they're paying back their bills. And that's a measure of the risk, is what interest rate they're paying. So that makes sense to me. So you got some equity in the company. You're an investor in the company. They're raising through a debt offering, and they're going to pay a certain interest to the people that are lending the money. Correct. Okay, fine. Hedge your risk with the equity side of your purchase with some of the bonds. Okay, but then it layers on top of that with derivatives and volatility.
Okay, how about I'm going to bring another derivative in that's very important for Rogers Communications. They did not have $1 of revenues. All of their business was in Canada, yet they borrowed money in US dollars. As a derivative, did it make sense, therefore, for Rogers to hedge their foreign exchange exposure? And I'm going to hope you say absolutely.
I would
So
suppose.
that's a
Yeah,
derivative.
okay.
That's a
Okay,
derivative. It's
so
called a swap. It's called
a currency
okay.
swap. Is that what it is?
That's it. That's exactly what it is. Okay.
So sure, yeah, get some currency swaps to hedge your risk of the USD CAD rate,
Yes.
because it's very volatile. It goes 30% up
you.
and down.
Thank you. Now, why were they issuing in the US market at a fixed term versus borrowing all their money from the banks in Canada? Because they wanted to lock in a term structure of their funding. So the banks in Canada would not lend for more than 5 years, but the US high yield market would lend for 10 years. So Ted said, I think in 10 years, my company is going to be a meaningfully better credit. And I believe I have the cash flow to get me out there. And I want to have this, the confidence, my investors, so I could raise the money, build my cable and wireless plant. Does that make sense? I hope you're going to say yes. Okay, so that's another derivative. Okay, and so derivatives themselves are not that bad a thing. Right. It just gives the CFO of Rogers Communications. She happened to be a really lovely lady, and she was smart enough to do this because it was actually managing risk of building out a world-class cable and wireless plant.
So that makes a lot of sense. But then you get into, say, the 90s when JP Morgan and these banks started to come up with these structured products that you were talking about earlier.
Yes.
That's when the sort of casino things felt like it came in.
Beautiful. I will tell you that was called credit rating arbitrage. And when you have an inefficient organization like a credit rating agency defining whether a investment product is investment grade or non-investment grade without considering the price of that investment, Brad, don't you think that starts the casino? Meaning they will rate something.
Well, just even having those people have the ability to arbitrarily be the king of what's risky and what's not risky and what's creditworthy and what's not creditworthy.
Without considering price,
not even considering price. But I recently read the book Fiasco, which talked about the whole thing in the 90s about how the derivative situation got blown up, and even cities like Orange County were buying these crazy derivatives products that they didn't really know what the risk was because they were just rated AAA, so they would buy them.
Isn't that the truth?
And so what they were talking about is these structured notes they would make where it was like some foreign jurisdiction, they would bundle a little bit of AAA stuff with something that was really unknown, but the credit agencies would say, well, I guess since there's some AAA in this, even though this other thing is like an F,
Yeah, that's fair. It's not an F, it would be a triple C.
Product.
No, well, okay. So you're right. Now, then you always look towards the markets and you see what the market's charging, or what the yield is on that product. And even if it has the coveted AAA rating, but it's yielding like 200 basis points over treasuries, a spread that would indicate much closer to a double B or a single B, what are you going to take? Are you going to take the market's interpretation of what it's worth or a subjective credit rating? And you better take the market's I guess calculation or the market's opinion of what it's worth, because markets are truth. Okay, subjective credit rating agencies.
On that point, that makes sense. But as far as I understand it, we're in a situation where the regulations say that if something is rated below, like if it's junk status, right? Which is what B or something?
Roger, anything below a triple B minus. Triple B minus is the lowest level of what they term investment grade. Now, isn't this funny? We haven't talked about price. We haven't talked about the yield that something trades at, the return for that risk. They have deemed anything below triple B minus, so that is double B plus, double B minus, single B, triple C, etc. Yes, that is non-investment.
So registered funds, like say retirement funds and stuff like that, they cannot hold junk bonds in their portfolios.
It's not regulated. That it's set up by their investment committees. That is correct. Yes, generally. But
I thought the government pension.
I'm not aware of that. Well, okay, but again, it's not the government that defines that. It's the manager of the fund says, I'm not going to hold non-investment grade bonds, but I'll own the equities of non-investment grade issuers. This is the same thing with Rogers Communications. It made no darn sense that this was the way it worked, except for inefficient investment guidelines based on inefficient credit rating agency opinions.
But we get into a situation like we're in, I feel like right now, where the market is telling us one thing and the ratings agencies are telling us another thing.
Thank you. What is an example of that right now?
A lot of, as far as I know, a lot of like Fortune 500 corporate bonds are pretty much in junk status, but they're rated still A and B because they're not allowed to.
The beautiful thing about corporate bonds is that it's a much more efficient market. But you're right. One of the reasons the Fed was rumored to come into the high yield market and be able to buy high yield bonds was due to 4 credits that are on the cusp of being downgraded. Okay. Right. Those 4 credits are General Electric, General Motors, Ford, and AT&T. The cumulative size of the balance sheets of those 4 credits is larger than the high yield market. Okay. Those 4 credits would overwhelm the high yield market if they happen to be downgraded. So the Fed comes up and says, yeah, I'd be able to buy high yield bonds. Why? The Fed wanted to assure that there wasn't cross or contagious selling out of the bond market, which caused equities to get crushed, which caused people to run to buy vol, which caused equity markets to be even more in a shambles, because that's how vol works.
Right, which is socializing the stock market
socializing.
In a way.
Well, okay. Hey, you know what? Yes, you're right. It is socializing that it's socializing the stock market,
because the central bank is saying we don't want to see the risk get flushed out of the system, so we're just going to put it on our balance sheet, and then the public
we'll backstop it. We'll backstop it, and then what do people do? Well, the Fed's going to backstop it, so I'm going to be just a little bit better than the Fed. I'm going to be a little bit better bid than the Fed, because I know if I buy it and I need to sell it, the Fed will buy it from me. But if I buy it before the Fed and it continues to rise in price,
it's a low risk thing.
Lower risk, yes.
Lower
risk. Okay. So here I wanted to hit.
But fundamentally, the product still fundamentally has a ton of risk. If it's being downgraded, if it should be downgraded, it should be because of fundamental reasons, because the market is saying it.
No question.
So it skews the free market because the central banks are coming in and manipulating everything.
Excellent word, skew. Yes, correct.
So it really takes away the efficiency of a market if the Federal Reserve is...
God bless you. Exactly. It takes away the open market pricing mechanism for risk.
Yeah, which kind of seems like a big casino scam to me.
Okay. Yeah, I love the way that it's definitely a scam. It's definitely a scam, okay? And it's basically socializing losses or providing a backstop for this to continue. It allows for the leverage in the system to continue.
Yes, yeah. So it prevents any of the toxicity from flushing out of the system, or not any, but a lot of, because in the way I'm looking at it, it's not just the ratings of the bonds and all that stuff. Combine that with the quantitative easing and the Federal Reserve printing everything.
Yes, sir.
Combine that with like the insane amount of stock buybacks that have been happening over the last 10 years.
How did they fund those buybacks? In a lot of cases, they issued more
pension.
debt.
Isn't it through pension companies buying? So credit funds get money from taxpayers, and then the credit funds give it to the corporations, and the corporations.
Well, that's what I mean. The corporations issue debt. They issue debt to retire stock,
and then the price pumps because they're just buying stock continuously.
There's that, and also the earnings are divided on a lower base of amount of shares outstanding. So their earnings per share can go up because the amount of shares outstanding goes down.
Okay.
Oh yeah, come on, and that's EPS.
So there's a supply constraint.
With
a price. With a purchasing increase.
Yes, absolutely.
So it makes it even. So I read something that something like 90% of the growth of Boeing stock over the last 5-6 years is directly attributed to stock buyback.
I think you could. There's a number of companies, without picking on Boeing, that are exactly the same thing. Correct. You need to understand capital structure arbitrage. You need to understand that there are cash flows that accrue to the various portions of the capital structure. Like a cascade, and there's no way you can tell me that you should not own the bonds of a company if you already own the equity. And the flip side is, if you own the equity of a company and have no idea where the debt of that company is trading, you're a knucklehead. Okay, so who's one of the biggest knuckleheads out there? Joe Weisenthal, knucklehead number one from Bloomberg, because Joe Weisenthal said, go out and buy the equity of Hertz. Because Hertz might come. And hey,
When
Joe,
did he say that though? When it was
right,
bankrupt?
exactly. When the Hertz bonds were trading at 40 cents on the dollar. Okay.
Was this already
Yeah.
when they announced bankruptcy?
Yes, after they announced bankruptcy, Joe says, hey, Hertz might have some value. Joe's a knucklehead, okay? Joe is really the most poorly educated financial analyst.
Greg, you don't want to be saying that about me.
I don't know who is that. How we? I'll tell you what.
That's my
I've had a few Twitter.
impression.
Is that right? I've had a few back and forths with Joe, and I just don't agree with his math skills because they are fucking terrible. He's got very poor math skills.
You know, I like Joe. So just full disclosure,
That's
even though he's a bit of a Bitcoin. Not a skeptic, but he likes to troll.
He definitely fans the flames. There's no question.
Us. But when I hear him speak about Bitcoin, I think he gets it. I think he does understand Bitcoin.
There's no question he gets it. He just may be conflicted.
He has conflict with a lot of Bitcoiners because he doesn't believe the narrative that the dollar is going to go to shit. And
that's fair. Look, I'll just tell you, I don't even want to take issue with that. I'll tell you, my issue was with Finance 101, where he speculates on the value of an equity from a platform with multiple thousands of followers that he has, fanning the flames of something that is absolutely worth zero. It has option value, but he gets more people to go in and buy this thing. And they have no idea that the bonds are trading at 40 cents on the dollar. And I'll tell you, if the bonds weren't worth 100 cents on the dollar, the equity was worth zero. So please don't go out and tell people that there could be value in the equity. What you're supposed to do is say, hey, those bonds at 40 cents on the dollar might be worth 60 cents on the dollar. That's a 50% return on your risk.
Back up for a second. You said something that I kind of disagree with now. Okay. I think maybe from a fundamental perspective, you're correct, but it seems like in the environment we're in right now, the logic doesn't seem to flow to me anymore. If you own the equities of something, you got to hedge with the bonds. And
not hedge. Understand where they're trading. Just understand where they're trading. That's the first order of analysis. If you are second claim in a capital structure, you better understand where the first claim in the capital structure is trading. Because if you don't,
but doesn't that actually kind of like assume or require you to believe that we're on a fundamental basis still?
Okay, so here's the neat thing. Yes, it does. But how about if you're an equity analyst, you're paid by your institution to provide fundamental research on the value of the capital structure of a company, and you haven't done that research yourself? I would argue that that is a breach of your fiduciary responsibility to understand your recommendation. You cannot possibly recommend a stock or a subordinate claim if the bonds are trading where, it indicates that the stock has no value. You need to go out with a disclaimer and say, excuse me, these bonds are indicating you have zero recovery value in your equity. But if you want to speculate or you call it a casino, this is where you call out the casino nature of it. Because the only way you'll make money is if it's a greater fool. If you buy it at this price and the greater fool comes along and buys it at a higher price.
But what about when the greater fool is the taxpayer through their
I would argue, okay, there certainly were cases of the Fed buying a basket of high yield securities that indicated some of their purchases were probably not that intelligent. But that's what happens when you're an elephant in the room and you need to buy a vertical tranche of a fund that's traded by BlackRock. And in that tranche, there's some securities that certainly aren't worth their trading value. Okay. Is that funded by the taxpayer? Yes, it is. But generally, and I'm just going to, because I still have some confidence that the capital system works. Okay. There's a minuscule part of me.
Tina says most investors don't understand capital structure. I think that's what you're saying. And I don't think I understand it really.
Well, that's a shame then, because
I'm just looking at what's happening, like the quantitative easing, all the bailouts. That doesn't seem to be a free market to me. That seems to be like total manipulation.
Right. It's not. Well, it's either that or socialized capitalism, right? I mean, it's like we're going to protect the big guys because they can take all the risks, and if the risks come home to roost, we'll backstop them.
Yeah, which kind of like it kind of makes me feel
sad, mad,
yeah, disheartened. You have angry, and a lot of people seem to be feeling like that because most of the people that are getting the benefits of all these socialized
The Cantillon effect,
gains.
correct? Yeah.
It's not average people. Like most people don't have
I need
exposure.
to hit on something. I really need to hit on something because I'm not sure when you're going to kick me off your broadcast. But here's what I need to hit on, okay?
I got lots of time.
We need to hit on Canada and what the markets are charging Canada versus what the rating agencies have Canada rated as versus what our politicians believe to be the case versus what's the reality, okay? This is so important for my kids, and I know you have kids. I saw your Halloween video, by the way. I wanted to shout out to that, where you put Bitcoin in your Halloween treat box. I mean, that was brilliant.
That was fun.
So you have kids. I have kids. Okay, we have politicians in Canada that believe Canada is AAA rated, which they are by the rating agencies, but they believe that we're sort of infallible. The markets are telling us right now that Canada is much closer to Russia in terms of credit quality than we are to the United States, okay? We are in big trouble in Canada. The markets are telling us we're in big trouble, and the politicians have no clue. So you say in 2008, 2009, when all of this financial alchemy was coming together, well, right now we have guys promoting Canada as, oh, well, we can issue all the debt we want because we're AAA rated. Guess what? You're being rated as single A equivalent debt in the credit default swap market, and that does not last forever. And if you don't get our house in order, the markets will ensure that we will pay a hefty price for that.
So the credit default swap market, can you explain a little bit, like Eli 5, how that relates to what you were just talking about?
Sure. Can you tell me what Eli 5 means?
Explain like I'm 5.
Okay. Okay. So Eli 5. Okay. So
you explain CDS. I'll explain Eli 5.
Okay. So here we go. Okay. So CDS. What is CDS? It's called credit default swap. It is indicative of a premium that a borrower will go to the market to protect debt that it already owns. So if I have lent money to the government of Canada and I'm concerned about the risk of default of the government of Canada, I can go to the insurance market, the CDS or default insurance market, and I can pay a premium measured in basis points on an annual basis to insure my debt. It's a beautiful instrument. You could say it's financial alchemy or it's a casino or it's everything like that. And I'll just say, heck no. This is about being able to hedge some of your risk as a lender to the to government. So government of Canada has a spread. All these other sovereign nations have spreads, and the height of the spread or the measure of the spread or the premium indicates how risky a borrower is relative to other borrowers. Okay, so you mentioned to me Turkey. Turkey's at the bottom of the spectrum. It pays about 430 basis points a year to insure.
So basis points, for people who don't understand that term, is at 4.3% interest?
That was exactly right. There's 100 basis points in 1%. So 435 basis points is 4.35% per year, which that means
for what? Their government bonds?
No, to insure. So it costs you to insure $10 million of Turkish debt. You have to pay a premium per year of $435,000 a year. And that means that if that debt defaults, you get your $10 million back. It's like an insurance premium on your house. If your house burns down.
Who's giving you the money back?
The person that sold you the contract, the person like an insurance company. It's not always an insurance company. Many times it's a sophisticated Wall Street investment house like Goldman or Lehman or whatever. But here's what, and this is in my Twitter handle, and it's probably lost on you. In 2006, you could buy protection on Lehman Brothers for 9 basis points. It cost you $9,000 a year to insure $10 million of Lehman Brothers debt. 3 years later, that contract was worth $6 million, from $9,000 a year to $6 million. Hey, that's a pretty good investment, isn't it? Or hedge. That's what default insurance is. That's where I spent my whole life trading credit risk premiums. And why do you trade them? Because it's set in the open market amongst some of the most sophisticated risk managers in the world. And what can you make of these products? Well, you can do like Bill Ackman did, and he bought insurance on a basket of corporate credits. And the person selling him the corporate credits is like an insurance company. They collect a premium, and you hope that, you know, you have exposure to only certain credits in that structure. And if they do default, the money you get from the other credits that don't default, you're making out like a good insurance company.
Okay, so this is kind of what blew up the system in 2008, right? But it was mortgage-backed securities rather than...
Same thing though, structured product, structured credit product, correct.
And people were, there was a lot of money to be made buying and selling these derivative products.
Oh yeah.
And banks will just, like, what the banks are incentivized to do is just sell a lot of products and make fees, because the salespeople at the banks are just hustlers and they're just trying to make fees and make fees and make fees.
Who was one of the biggest purchasers or sellers of this protection? So who did Wall Street run to sell protection on these products? And I'm going to make the answer simple for you. It was Canada. Canada bought a total of $32 billion of this structured product. And the Caisse de dépôt et placement de Quebec, Quebec's pension fund, owned one half of that. They owned $16 billion, or 10% of their assets were in this structured product called asset-backed commercial paper. Okay. They bought it because they were getting a whole 6 basis points per year more than what's called bank-sponsored asset-backed commercial paper. So Deutsche Bank was running, and JP Morgan and some of these large investment banks were running to Canada to the tune of $16 billion to one account. And he was getting 6 basis points more per annum. I figure on that $16 billion, I think the fair price would have been about a 10% change in the value of the security. I think they made close to $1 billion just off of Quebec pensioners.
Because and then what Quebec happened when it blew up?
Guess where the price went? Went from 100 cents on the dollar down to 25 cents on the dollar.
So did they have to get bailed out by the Bank of Canada?
They had to take that mark-to-market loss. And guess who suffers? Did. Yeah. And guess who suffers? Quebec pensioners, okay? Because they had 10% of their assets in something that went down 80% or 75%. Now, I was at a hedge fund that happened to be on the other side of that. Let that be a lesson,
everybody. Don't buy shit coins.
That's fair. I'll risk is risk, you guys. And if you don't do your homework, you're going to get burned. And I'll just say that I was on the other side of that trade, and we were at a fund that was buying this stuff at 25 cents on the dollar.
Okay.
Because we did the math and we determined how we could hedge our risk. And we actually thought that the bonds at 25 cents on the dollar were worth far more than that. And eventually they were restructured, and they did return 100 cents on the dollar. Okay. So,
but that was because the Fed came in and bailed it out, right?
Zero. Nope. Not one bit. It was all open market pricing.
Okay. Well, how does that work though? Because if it was the products that were blowing up in the US, like the mortgage-backed securities or the collateralized debt obligations or whatever.
That's what it was, a CDO. That's correct.
Didn't the Fed have to come in and kind of like socialize it?
They backed the people that were exposed to them. They did not back the product themselves. They had these things called the TARP, which was Troubled Asset Relief Program, but none of this stuff from Canada flowed into the Troubled Asset Relief Program. Okay. So TARP did not, by stabilizing the financial system, absolutely it helped, but it didn't help that product per se.
Right. So, but like, I guess, they didn't bail out per se the specific assets that were in trouble. They just backstopped the banks,
the players, correct,
and then just pumped as much money as
so
possible.
The answer would have been,
economy.
Wouldn't it have been a wonderful thing if the Case had sat on their exposure? Meaning, I know I made a mistake by lending it at 100 cents on the dollar. It really should have been done at 85 cents on the dollar. But then they sold it, and they actually panicked out of their trade at absolutely the worst point, which is what markets tend to do to you. They shake you out at exactly the wrong spot. And Canadian pensioners were worse off. And that wasn't just Canadian pensioners. That was 16 billion of it. I was buying some of this stuff from Canadian endowments, university endowment funds. That was horrible. But They wanted to sell, and we had to, we happened to think that the price they were selling at was too low.
Mm-hmm. Well, I mean, hindsight though, too. Like, who would have known the Federal Reserve was going to print like $15 trillion to
Okay,
keep
that's
the
fair, but
party
those are
going?
risks, yeah, or not keep it going, keep it from imploding. Because honestly, there were times I was going to work, I was certain it was over. I was absolutely certain, Brad, that it was over. On certain days in March, leading up to March 2009, I was certain it was over.
Okay, so fast forward now, we're 10, 12 years on, and we're talking about how the Canadian debt,
same thing.
what did you call it? A CDS?
Yeah, credit default swap.
Credit default swap market is pricing the Canadian bond insurance. Is that what it is?
That's
bond
it.
insurance?
Attaboy. Yeah, attaboy.
At 4%, did you say?
No. That's Turkey. Canada's only at 30 basis points. So that's 0.3%. But if it truly was a AAA credit, it would be trading at close to 10 basis points. Now you'll say, what's the difference between 10 and 30? For some people, that's their entire life. Okay. When you're an investment grade or an IG trader, 20 basis points is like the difference between night and day. And the difference between a AAA credit rating and a single A plus or a single A credit rating is also night and day. It just gives you the number of different buyers that can buy that. So there's Tina again. There are no bad bonds, only bad prices. Hallelujah. I agree with that. And therefore, you should never say or define something as being investment grade versus non-investment grade without considering the price. Thank you, Tina. There's no bad bonds, only bad prices. Okay. And you always need, so I would say, for example, I'll turn a junk bond or a non-investment grade bond into an investment grade bond, provided I buy it at the right price so that my anticipated return rewards me for the risk. You can't do it any other way, guys. Bonds trade for price, equities trade for price. It's all about getting rewarded for the risk of putting your dollar of capital up in the open market.
Okay, so let's look at this again from a bit more of a higher perspective. So we've got these massive amount of bonds all over the place with countries and corporations.
Yes, sir.
Counties, everything, like provinces, whatever.
Provinces,
everybody's
states,
got
municipalities. Yeah, that's what it is.
So there's huge amounts of bonds out there, and they've been producing income for a long time, and there's a huge amount of money that's parked in bonds to earn, they call it the fixed income.
That's why they call it
market.
Fixed, correct? Yeah.
Because they're earning interest rates. The interest rates are going lower and lower and lower. The debt to GDP ratios are going higher and higher and higher. The national debts are going higher and higher and higher. And we've got all this risk in the CDS markets. We've got artificially low interest rates from central bankers to try to keep everybody putting their money at risk.
Attaboy, yeah.
And this all to me seems like it's ready to just explode in a way that's going to like make it so that if you do have this insurance because you've done all the hedging and you've taken the risk calculations, and it seems to me like it's just not going to work, because who insures the insurance companies and who insures the banks that are...
Okay, there you go. You're onto it. And so I have lived through 4 of these in my life. In 30 years of trading credit, I've lived through 4 of these episodes. And in successive episodes, it just got worse. And the ultimate backstop now is that the governments own all the risk that were previously on. It started with banks. Then it went to hedge funds like long-term capital. Then it went to structured product that again caused the leverage unwind. And now all of that financial risk lives on the balance sheets of the governments. And guess what? There's nobody behind the governments. That's it.
So Jeff Booth, I interviewed him recently, and and we kind of touched on this subject too. And we talked about how in the 80s and 90s, the 70s, 80s, and 90s, when the interest rates were allowed to float more freely, like based on the market conditions, not based on some central planner guy saying, I want low interest rates.
Yeah.
That when they raised interest rates back then, most of the debt was owned by people and businesses because it was a free market and it was more efficient. So when
versus
they raised
the debt being owned by the central bank, you're 100% correct.
So
now don't forget a lot of it. Well, but a lot of those, the natural, the decline in interest rates was a lot set by the open market for a while. It was raised in 1980 by Paul Volcker because inflation was through the roof due to things like the oil price shock and everything. But then it went from 14% and it went down to under 1% in the US 10-year just because inflation expectations also went down. Now, the central banks were pushing on the button to say, okay, I'm reducing the overnight rate, I'm reducing the Fed funds rate because it fuels the economy. There's no question. But it's not like inflation was running the way they measure it anyway. It's not like the way when they measured inflation that it was running at 5% and their nominal rates were below 5%. It wasn't like that. Just so happens, though, that it was a 40-year bull market in bonds, or another way of saying that is interest rates declined for 40 years. Now it's different. It's not who owned the bonds as much, Brad. It's just that you benefited from 1982. Paul Volcker raised the overnight rate, the Fed funds rate, to close to 20%. Hey, it happened. Can you imagine being back in those days and say, if I can get 20% return in government bonds, what the heck is equity supposed to return, given that they're that much more risky?
Well, if they raise those rates too, that would raise rates on everything, including mortgages and loans.
100%. But again, if that's the base rate of calculating a risk, everything else is measured on top of that. Then again, you'll have your mortgage rates, you'll have your equity returns, you'll have successive risk layers.
And like we were saying, now most of the debt is owned by, it's kind of socialized.
A lot of it's owned by the central banks, correct? The central bank shenanigans. So, where are we going to go with this? I'll just tell you, I view Bitcoin as being default protection that's not provided by any counterparty. So you have no counterparty risk. You own default protection on a basket of sovereign credits. It's called Bitcoin. It's the most beautiful financial innovation I've ever seen in 30 years. I can measure what its value is based on the credit default swap markets today. I'll tell you that anybody who does not own Bitcoin right now and owns fixed income is being a fool. Okay. If you own any type of fixed income in any market, and you can go starting with sovereigns, and you can go to high yield, and you can go to bank loans, and you could go to MBS, you need to own Bitcoin as insurance against your fixed income exposure.
So decentralized default insurance. I love it.
That's what it is. That's what Bitcoin is in 30 years. That's what it means to Greg Foss, because it is insurance on the ultimate default, because all fiats are going to default. It's just mathematics. Doesn't know what time it'll take place, but of the 180 fiats that are out there, they're regularly defaulting. And if you are living in those countries, you need protection against that, or else you're putting your family at undue risk.
Yeah, it's kind of like FDIC insurance in a way. Like these things are stories that we are told, just like paying off your debts and saving for retirement. It's just a story that we're told to paper over the reality of, which is much more scary, and it's a bunch of people that don't know what the hell they're doing.
So Henry Ford in the day, probably in the 1920s, said if the average American understood how the American banking system worked, they would not put their money in banks.
Well, FDIC insurance is really a joke. There's only about 1% of the money in the FDIC fund.
Okay, but what is the implied backstop? It's again the government, which means they can print money to get enough money in the FDIC to backstop the deposits.
If say 10% of the money was lost, which is kind of a silly notion even too. That's a romantic notion that the money can be lost. It's just entries in a database. Dollars now are just
fair enough. And it's not 10%, by the way. It's 4%. Okay. The banking system is levered 25 times. So you don't even need to lose 10%. You just need to lose 4%, because that's what banking is. All right. And we've had this sort of, you've hinted at this. So
even a 1% loss then would be like the equivalent of 25%.
Correct, sir. That's exactly
And
what
the
happens.
FDIC fund only has 1%.
Okay. Yeah, but that's on the
available.
deposit side. Yeah. Okay. Yeah, I see where you're going with this. But the reality is there's an equity buffer first, and that's what the banks have, is called an equity buffer against their losses. And that equity buffer typically is only 4% of their risk assets outstanding. Okay.
What does that mean, an equity buffer?
Well, that's what equity is in banks, right? Equity is your first line of defense. It's why the banks have equity, because that equity protects against expected and unexpected losses in the banking system.
Well, what would be qualified as equity for a major bank?
Stock that trades on the on the Toronto Stock Exchange.
So the banks own stock, or they're buying stocks from other banks?
Well, no, they've issued equity into the open market. They pay a dividend on that equity. Investors own that equity. Most Canadians own it because they think the banks are too big to fail, and therein starts the whole thing again. They have that equity that it trades on the Toronto Stock Exchange. It has a market cap of combined market cap of Canadian banks is somewhere around $500 billion. That's the equity buffer that protects against all the loans that are out there against that $500 billion of market equity.
Okay, so we're talking about the loans as in the unsecured
they make loans to
stuff?
they make loans to corporations. They make loans to Brad Mills and his family potentially on your house. I don't know, but the small business, all these loans that banks make.
So there's two types of loans banks make. There's secured and unsecured.
Generally, they're all secured. It doesn't really matter. There's losses on both of them when they make a bad loan.
Right.
The security typically does not match.
Which is relevant. I mean, I want to discuss this a little bit more because it's relevant right now, because Canadians are levered up more than I think any other Western country. For every $1 that we make, there's $1.70 in debt that's owed out. And most Canadians don't have really much savings at all. They don't have investments. The average Canadian makes something like $50,000 a year, and expenses are a lot more than that.
That's fair. That's fair. Yeah.
And whether it's our consumer society or the way that banks prey on you as soon as you enter a university, you're getting sold credit cards and student loans and everything. Whatever it is, people are living above their means. I know, like my neighborhood right now, the houses have gone up 100% or more in the last 10 years. It's insane. Like I've got neighbors that are just, they're teachers, or they're just working for regular middle-class jobs, but their houses are like $700,000, $800,000, and it just seems like there's so much debt in both the U.S. system, and the Canadian system is even more. And how in the world, if things start to correct, like if the real estate market starts to correct, people start to default on their debts, their car loans or student loans, their mortgages.
So that's 2007, 2008, all over again, correct? Yeah.
So the banks have been, trying to get up to the Basel III requirements, which tell them that they have to keep a certain amount of money.
That's what I'm talking about. Yeah. So capital. It's called capital.
That 4% number that you were talking about, equity is an equity backstop, which is equity of their own bank that they've issued.
That's correct. Yeah.
But they're also supposed to have 10% or 8% or something like that of base money, like real money, to back the liabilities.
It's a combination. It's equity and it's debt. And I'll ask you, is subordinate debt that backs a bank, is that actually a risk absorbing shock absorber? And I'll go, no, that's a goof. Okay. The only risk absorbing shock absorber is called equity. Because if you are using debt as a shock absorber, well, that debt has a claim, and all of a sudden you don't have a business anymore, because that debt can be asked to be paid back. And if it's not getting paid back, that's when you default. Equity, you don't default on equity. Equity is your shock absorber. Equity is the part of the banking system. So that's why I said.
But here's the thing that makes me, and let me try to explain this for people who aren't following super deeply. So in the Basel requirements, this isn't a regulated thing. It's just a suggestion by all
some of them are regulated. So Basel 1, Basel 2. Yep. Those things are actually regulated.
Well, they're more like a set of rules that the banks are supposed to be following.
Fair enough. That's fair.
But there's no, nobody's going to go to jail if the bank's not.
No, but what if you don't meet these guidelines and you're on the bad boy list? Do you think people are running to you to give you their deposits?
This is why I don't know if any of this makes much sense in a crash, and why I don't feel much security by the 4% equity backstop or anything, because we did see the crash happen last year.
Bingo.
And even before that, 2 years before that, in 2019, September, October 2019, we saw the banks stop lending to each other, and then the overnight lending rate shot up way high, like 20% or something, which showed likely that there was some banks that have toxic debt
100%.
and their equity
gurgling in the system. In the system.
People were speculating maybe it was Deutsche Bank or one of the big globally systemic important banks were insolvent because
they're insolvent on a regular basis. Okay, banks are insolvent on a regular basis if you were to market their portfolio. Why? Again, they only have 4% buffer. And I'm going to give you the real goods here. When I started in 1988, my first job out of MBA, coming back to Canada, I worked for Royal Bank of Canada, and it was insolvent. Canada's largest financial institution was insolvent due to its loans to lesser developed countries, LDC, primarily Brazil and Mexico. If you took those loans and marked those loans from the 100 cents on the dollar where they were issued down to where they were trading in the secondary market, you evaporated the book value of equity of the Royal Bank of Canada, full stop. And it wasn't just Royal Bank, it was all the money center banks in New York as well. Very simple calculation that none of the equity analysts actually did because they weren't smart enough to do it. Yet the CFOs and Treasury Secretary Nicholas Brady of the U.S. Treasury said, we need to solve this. And they turned 5-year loans into 30-year obligations. And it was called the Brady Plan. You need to look it up. In 1988, Royal Bank of Canada.
Is that the same as Brady bonds?
That's exactly the same thing. It's where I got my start. It's the first instrument that I traded 30 years ago called Brady bonds. It was a beautiful restructuring of a dumb loan that was made and continues to get made by the banking systems because banks are levered 25-1 and they lend out money at times irresponsibly. And this was an example of the banking system being insolvent. Again, it wasn't just Canada. It was everywhere in the world. And Brady bonds were issued to bail out the system. First experience in my career of 4 times when banks have been insolvent. Okay, you can set your watch by it.
Okay, so we know that the banks are gonna, like, not just the banks, but the central banks too, are gonna just do some creative Hollywood accounting whenever they can to prevent the system from failing, like they did then.
They always do, correct.
And like they did in 2019 when the overnight lending window went haywire, and the Federal Reserve just said, okay, well now instead of you guys lending to each other, the banks,
I'll open the window.
You can just borrow from us. We'll give you hundreds of billions.
Do you think it was any different in 1988? No, absolutely no difference. People understand the way the system works better now. Do you think it was different in 2000 with long-term capital management?
The difference was back then that I've kind of come to figure out is that the debt to GDP ratio was much lower back in 2008.
Don't confuse banking with the debts on government balance sheets. Yes, they were lower, but why did they increase? One of the reasons they increase is because they keep having to bail out the system. Right, so when they bail out the system, it makes their debts expand. So now we're at the end game because there's no more room to bail out the system. They have successfully expanded their balance sheets so big that mathematically it is impossible for the GDP of the world to grow fast enough so that the total debt is in control. It's only math.
It makes no sense.
Well, it makes 100% sense. It's called math.
It makes no sense.
The fact that they did it makes no sense, but they did because none of them are very good at math, and all of them are in office for 4 years, and they'll just kick the can down the road and say, well, this is someone else's problem.
Right. And they've been doing that for so long, since at least 2000. And
correct.
2008 is when they really started the money printing with the quantitative easing, which put everything on steroids. Actually, they've been doing it since the 70s when they went off the gold standard. That's really the first big.
There you go. Okay,
big problem.
That's what WTF happened in 1971. That was the beginning.
Yeah. So, but now with these Basel Accords, like there was this like 5-year, I think it was, plan where they were going to slowly let the banks get to 100% following the rules, and then COVID happened,
Of course.
and they canned everything.
Of course.
They just suspended all the Basel requirements. They said you guys don't need to have any base money back in your loan.
Here's the funny thing. When I was working for the Royal Bank of Canada in 1988, my second project was to work on the first Basel Accord. Okay. In 1990, I was working on Basel 1. That's 1990. Then I worked on it and I said, wow, well, this doesn't make a whole lot of sense. Why? Why does it exist like that? Okay, very simply because the governments can print money. And by printing money, they can bail out the system, and therefore the system can pretend that it's bulletproof. Well, it's never bulletproof. It only has a backstop that's bulletproof. And that was the first time in my career I started questioning the fiat system. And I said, I need to find a solution to this. And finally, I did find Bitcoin.
Yeah, Bitcoin is obviously like showing itself as great insurance against these people that are central planning and trying to control everything and stop the inevitable from happening, which is most likely that the risk is going to get flushed out and people are going to be in trouble.
It happens on a regular basis. But again, we live in a fairly protected area called G7. So Canada's part of the G7 countries. But imagine if you live in countries that are, you know, in the sub G100, right? The 80 fiat currencies that are, you know, always running to the International Monetary Fund, the IMF, for help. These are places that need Bitcoin more than ever today. And then I'm going to wave the alarm again. And I'm going to tell you, if there's a G7 country that's going to default first, the market is telling you it's Canada right now. That's not something I want to be winning that race. The market is telling Canada that of the G7 countries out there, you're in the worst fiscal shape. It's not hard to explain why we're in the worst fiscal shape, but everybody in Canada thinks we're AAA. And the funny thing is, United States by S&P is only AA+ rated. Canada has this mythical AAA credit rating that's actually higher. The credit rating is actually higher than the United States, yet the market has totally flipped that on its ear and said, Canada, you're not even close to being able to borrow at the same rates that the United States can borrow.
That's so strange, too, that our debt as a country per capita and based on GDP numbers, it's way higher than the United States.
So hence why is the market charging us a higher default swap premium or default insurance than the United States? Is very logical. So that's right. What is wrong in this situation? Is it the credit rating agency that may be wrong? I would say certainly.
Yeah,
same
probably.
thing happened. Oh, not only probably, like you got to give it almost 100% certainty. And then the biggest other side is our politicians have no idea. They just have no idea. They're assuming they still have this mythical AAA credit rating. You know, it's going to be
What do you think? Like for most people that aren't in Canada, they're listening to this. We got bailed out pretty good compared to most other countries with COVID relief, like individuals. I didn't get any of it. I didn't go for it, but like everybody got, what is it, like 30 weeks of $2,000 a week or something, or a month?
Yeah. I don't know the details, but we raised our per capita debt levels faster than any other G7 nation, and now we are second in line to Japan, but we have a much smaller economy. You know, we're a G7 country, but we just happen to be blessed to live next to the richest country in the world with the world's largest undefended border, but doesn't mean we can live like that forever.
So why does it, based on all this debt that we've issued, and like we can get into the oil situation too, if you have any knowledge of that, I'd like.
I think I do. Yeah, I think I do. Sure.
Because the way that I understand, I'm from the East Coast. I'm from Cape Breton, from Nova Scotia. It's a really like poor economic area, and people have seasonal work. A lot of people are seasonal workers, and then they go on EI. And there's a bit of like a battle between the mainland, Nova Scotia, and Cape Breton, because the mainland gets all this equalization money. And then Cape Breton has like 10% of the population, but only gets like 1% of the equalization money. So there's a lot of like economic downturn in Cape Breton for years.
Okay.
And Halifax gets most of the money, and they don't send it to Cape Breton.
Okay.
So Cape Breton to me feels like this is what happens when the socialization of the equalization of the country fails in a way.
Okay.
And I feel like that's what's going to happen with the whole country soon, because Alberta has been the biggest contributor to equalization. So Alberta's been
they
paying.
can't be anymore because their economy's in the worst shape it's been in the last 30 years. So
they're going to start needing equalization payments. So who's going to pay for that?
Guess.
The Canadian government.
Well, no, they'll print more money, right? I mean, this is the only mathematical solution, and this is why it pains me, because the math will indicate that this game has to continue. And my concern is the music stops. And I am not 100% certain it'll stop while I'm still alive, but I'm almost 100% certain it'll stop by the time my kids, are still living. And that's what pains me. I am part of the generation that pulled forward the wealth of Canada so we could live not in reality. We pulled forward debts, and we're leaving this to our future generations. So it's a very, very dangerous situation. It's only math. Again, you've called it out, Cape Breton. That could be an example of the entire Canada when we are living right next to the United States, because the last country to fail will be the USA. But ultimately, all countries will probably fail. The reason is mathematics. All fiats fail, right? All fiats fail, as Voltaire said. It's only mathematics. Okay, so I guess really what you need to understand is there will be a dual or a parallel system that's in existence. One that you have Ponzi money called fiat, and one that you have the most beautiful financial creation ever created called Bitcoin, with a 21 million hard cap to be able to share amongst all the countries in the world, not just Canada. So we need to get our share. As Canadians, we need to get our share. As part of the global population, we need to get our share, because it's the only solution, in my opinion.
Yeah, and for people that are thinking, like, how does 21 million actually scale to the 8 billion people in the world? It's divisible into 100 million units. So there's 21 quadrillion Satoshis available. So it is a scarce asset. It's got credible long-term scarcity. But you can break it down.
Well, that's fine. But anything to the right-hand side of the decimal point does not, you can put as many zeros to the right-hand side of the decimal point, Peter Schiff and David Rosenberg, who don't understand math. But yeah, it's divisible into 100 million. I have a question for you, actually, and I've never seen this written anywhere. Why 21 million? Was there a some sort of, not even scientific, but almost a mystical determination that 21 was some sort of number that
I've heard speculation on that before. I haven't really seen anywhere where there was a good answer for that. Okay. I just think it feels like it was just a number that was picked out.
Okay, so I've never seen it either, and I figured I'd ask you because you've been in this game, and it's not a game. You've been in this study. You've been studying it longer than I have, or maybe not longer, but you're certainly more public about it. So that's just a question that came up. But I will say this again, okay? Canada is in big trouble. We sold all our gold in 2016, I think it was. Okay. We sold all our gold. We have no gold as reserves. If Canada could get their head around owning Bitcoin, not just at the personal level, but also at the government level, I think it would be monumental. Now, the chances of that happening are very, very low. I'm hoping it's not zero, but if we have Pierre Poilievre or Pierre Poilievre, or however we say his name, the member of parliament from Carleton, Ottawa, Carleton, that's so on top of the Liberals and questioning their finances. All he needs to do is connect the dots and say, hey, we need to own some Bitcoin. That would be monumental for Canada.
Yeah.
What would it do for the price of Bitcoin? Well, we don't even have to go there, but I'll just tell you that if you're supposed to own it as an individual and you're supposed to own it in your corporate treasury, it's not a leap of faith to say that you should own some on the government balance sheet as well.
Yeah, that would be pretty good. I don't think there's going to be much of a likelihood chance because you see the way that Canada's like culturally shifting away from things that make sense and going towards
Isn't it sort
things
of
that
sad
don't
though?
make
Come
sense.
on, Brad. I mean, this is why you do your podcast though, because we're trying to break down these intellectual laziness of people to assume that Justin Trudeau actually understands mathematics, because it's clear he doesn't. Okay. It is absolutely 100% certain that he failed math. And that's unfortunate because he is running a country, and there's no difference.
It's an interesting experiment of the law of attraction. I mean, he says a lot of things that sound great, and he's like got the right energy, but that like I don't know.
You
I don't know
cannot say
what.
something like the budget will balance itself
Yeah, I
and
don't
get
know if
any
that
credibility.
reconciles.
You just can't. You can't. Okay. It's just, as a financial market player for 30 years, if any major corporation said that of the debt that I owned in that company, and if the CEO came out and made that ridiculous statement, I would sell everything I own and I would go to the other side and I would start shorting it, because I said the man does not understand financial risk and the necessity to have the confidence of the markets to believe you are acting in their best interests to protect their capital that you are investing into that country or a corporation. It's no different.
Well, I think if you just really understood the idea of quantum physics vibrational energy, then you'd get the value of Canadian bonds. You just have to think it will be worth something. And then you can just keep printing more and more. And the more that you think that it's not going to hyperinflate, the quantum physics is going to take care of it.
Okay, you Eli'd me, or how did you say, Eli fived me out of the conversation there? But I'm going to trust you. I
That
will
sounds like
say
that. Like that's the logic, right? Because when you look at
yeah,
the Alberta situation with the oil, you
yeah,
know, the Keystone pipe,
yeah.
that is going to decimate their economy. The shift away from the resource that is super abundant in Alberta and has been driving the equalization payments for the
Yes,
rest of
that's
the
right. That's
country.
fair. Yeah, yeah.
I don't know what is that going to have? Like, there's a huge environmental conversation that Canada's
ESG, no,
engaged
you're
in.
right. No, it's, yeah. And this is, you set up these ESG guidelines, environmental social governance guidelines. And if you're not investing in fossil fuels, which a lot of the biggest funds in the world are not, because they've regulated or just decided to, invoke these guidelines. Yeah. You've changed the entire, history of Alberta and our, oil sands, which have greater deposits than Saudi Arabia, right? We have more, call it whatever you want, oil sands or tar sands or dirty oil. We have more oil reserves than Saudi Arabia. Yet, that may only account for paving roads right now in Joe Biden's infrastructure, because that's where what heavy oil goes into is asphalt, is one of the subs or products that heavy oil is very valuable for. Look, we were blessed with natural resources in Canada, and we successfully not managed those that professionally, in my opinion.
So what do you think happens with the Alberta economy and the Canadian economy in general over the next 10 years?
If you had the opportunity to invest marginal capital right now in Ontario or Texas, right on the margin, you are an international capital allocator. You're looking to put a new factory in either Texas or Ontario. Where are you most likely to break ground? And I think
Texas.
the answer, yeah, 100%. Okay, so that's on the margin. Capital inflows into Canada are going to be challenged to our very substantial neighbor to the south, especially since they seem to be dealing with this pandemic far better than we are. That's number one. The second is, yeah, we are natural resource intensive. our economy is not nearly as diverse as the United States. So even though we're 1/10 the size of the United States in economic output, we're much more concentrated in those industries that could be impacted by negative events like ESG investing, so gold mining, mining commodities versus and oil versus services that the United States has become so expert at.
So what does that mean for the dollar, the Canadian dollar? What do you think?
I'm not bullish on the Canadian dollar.
No. Which is strange because it's been gaining strength over the last 6 to 8 months.
All fiat currencies are relative, okay? And the rate of decay is only relative. It doesn't matter in the short term. All of them are melting ice cubes. All of them are going down. It's just that Canada, in my opinion, over time, over the long run, will decay at a faster rate than the United States dollar. And we only trade against the United States dollar. Did you know that? The only cross-currency rate that trades in Canada is Canada-US. If you need to go from Canada over to British pounds, you have to do 2 swaps. You have to go Canada-US and then US GDP or Great British Pound or Great Britain GBP. This is funny. All of Canada has one exchange rate, and it's against the United States, whereas United States trades cross-currency against all the other fiats in the world. Why? Because it's the de facto global reserve currency. Again, Canada is 1/10 the size of the US. The size of the economy in Canada, our entire country is about that of California. We cannot fool ourselves that we are anything but a country that's 5,000 kilometers long and about 100 kilometers wide, a ribbon that stretches along the border of the United States.
Okay, so that's kind of like a long conversation about money, debt, the risks to the system.
It is.
And Bitcoin as a way to kind of protect yourself against all the
cards. And I sort of do the same thing sometimes. I'm not as philanthropic perhaps as you are, but I will encourage everybody to get a Bitcoin wallet. Whether you ever use it or not, you need to understand the technology that allows you to transfer store of wealth on a decentralized ledger from one, call it iPhone, to another. The most beautiful technology I've seen, and what I sometimes do, and this is back to your Halloween video, I go, if I'm at a restaurant and I talk to the waiter or waitress and I said, do you own Bitcoin? And generally they say, yes, sometimes they do. But if they don't, I say, hey, by the end of this conversation or the end of this dinner, if you download a Bitcoin wallet, I will tip you twice as much in Bitcoin as I would in fiat. And I've successfully done that a number of times where the waiter or waitress gets a Bitcoin wallet by the end of the dinner and I tip them and they get a Bitcoin wallet. Okay. And what have they done? They have experienced the technology of transferring a store of wealth from person to person. They could turn around and sell that or forget their, lose their phone or do all the other things that everyone's worried about. But generally, it's their inauguration into, as young kids, very comfortable doing commerce on a phone with no intermediary. They don't like the banks generally to begin with. This is disintermediating the banks. It exposes them to the Bitcoin and the blockchain network. And then if they get money in their life, they can start putting it also in their RRSPs and TFSAs using various different on-ramps. But unless you understand the technology, and then if you don't agree with it, you're allowed to tell me I have no idea what I'm talking about. But just about everybody out there that hates Bitcoin has not even done the due diligence of downloading a Bitcoin wallet and trying to understand the technology, right? That's the scary thing. They read in the newspaper that, oh my gosh, it uses all this energy, or oh my gosh, it's a Ponzi. And they haven't even done one layer of research. They haven't even peeled the onion back and understood how the transfer of wealth just occurs. And you're probably old enough to remember. Do you remember that guy in a Super Bowl one year? This must have been, I guess, almost 8 or 9 years ago, he had his Bitcoin address above his head on a big
Yeah, it was
cardboard.
like, "Hi,
Send
mom," I
me,
think.
no, he said, send me Bitcoin with his QR code there. And apparently he got like, tens of thousands of dollars of Bitcoin sent to him over the network back when Bitcoin was probably easily under $100 a coin.
Yeah.
The guy was brilliant. And yet even back then, there were enough people out there that freeze framed their television, snapped his QR code, and just happened to experience the beauty of this network. And that's all I'll encourage people to do. I know my kids all have Bitcoin wallets. I know your kids in your neighborhood, Brad, all have Bitcoin wallets because of you. But this is way too small a subset. We need guys like David Rosenberg to actually get a Bitcoin wallet rather than dissing it as being, what was his famous quote? Oh my God, it's worth more than the value of a Hyundai or a Honda. Didn't he say that one Bitcoin will now buy you a Honda Accord? Well, that's real great analysis, David. Like, that's one heck of an economic analysis that you think that Bitcoin has to be a farce because one Bitcoin can now buy a Honda Accord. Please, everyone out there, do some research, understand mathematics, and then you can diss it if you don't agree with it. But until you've done that research, you got to peel those layers of the onions.
Yeah, it's a very good point. It's also a bit frustrating to see people diss Bitcoin because of this superficial, shallow view of, the divisibility or the price or their unit
or
bias
lately
or whatever it is.
the energy too, right? That, especially for Canada.
Yeah.
So I'm involved in a company right now that what we're trying to do is bring scale to the flare gas capture of the Canadian energy space. And we have 35 megawatt jet engine turbines, basically, that we can wheel into flare gas sites. And within 6 hours, we can be up and mining Bitcoin using wasted energy that otherwise would be venting into the atmosphere and destroying the ozone, or being flared and causing CO2 and heat. And, there's just so many good things that come with Bitcoin. Yet all you'll ever read about are the people that are the fudsters.
Yeah, that's a big thing. Like, Bitcoin actually is one of the best things for green energy. It's like a free market bounty to innovate and find ways to use trapped energy or renewable energy, or just to innovate in general on energy technology.
So
Because
important.
there's like another 2 or 3 million Bitcoin that are going to be mined.
That's right. Yeah.
And there's this race right now. It's the only free market thing that there is at the moment that's not manipulated by some central planning government or trying to like print money to subsidize the technology. It's a free market element that's actually going to help people try to innovate and make things more efficient with solar power.
It sure is working right now, right?
Because if you can get Bitcoin mined at cheaper than anybody else, you win. You get free money. So people that are in the engineering space
absolutely
have an incentive to go look at, how do I make Bitcoin mining more efficient? Because I can get $1 billion if I'm the guy that figures out, or the girl that figures out how to make 0-point energy work or something like that.
Well, that's, and then a lot of cases in flare gas, right? The incentive is for the producer to give it to you at almost zero cost. For us, because they are restricted by the amount of flare gas that they produce. That restricts the amount of oil drilling that they can do. And so, there is incentives on all different levels, but perhaps the most important incentive is to actually efficiently use our natural resource energy, whether it's hydroelectric, whether it's flare gas, whether it's solar. Right now, it's very difficult to make the solar equation work in Bitcoin mining, but it doesn't mean it'll always be that way, because we always, as efficient humans, determine productivity. And I have big aspirations for Bitcoin helping to bring Canada's energy sector back from some pretty bad 1-2 punches, no question.
That's awesome. I'd love to be involved in that. How do I invest in that?
So right now it's a private company. It's called Validus Power. I promise you that if we go from around, a funding round, you'd be one of my first calls. We have a lot of people, very qualified people that are knocking on our door. Is the same way, Brad. It's so important for Canada. It's also important for the Bitcoin community, and therefore it's also important for the world. Yeah.
So are you guys doing just this waste gas flaring, or are you doing trap gas as well?
So right now it's focused. What we bring to the table is a solution that it can be run on any natural gas energy source. So and I'll take it one step further. We are also talking to small towns about it, because the town of Leamington, Ontario, for example, based in southern Ontario, is basically at capacity for the amount of greenhouse heating they can do, because Hydro One, the local utility, does not have any more capacity on the grid. Yet these farmers with their greenhouses that are growing tomatoes for Walmart, or actually in one case they supply all the cucumbers to Walmart North America, comes out of Leamington, Ontario. Well, they need to heat their greenhouses in the wintertime, and there's no capacity for that from the hydro electric grid, or the Hydro One rather grid. And our solution, we can wheel in these turbines. You can just attach them right to the Trans-Canada natural gas pipeline. It's not stranded energy per se, but the neat thing is it allows these farmers to heat their greenhouses in the wintertime, expand their production, so produce more cucumbers and everything. And then in the summertime, when they don't need the power, but they have this turbine sitting there, hey, guys, create a revenue stream by mining Bitcoin and diversify your business. So, there's just, again, we can call it stranded energy, whether it's inefficient use of the grid, whether you're actually mining Bitcoin 90% of the time and flipping a switch that stabilizes the grid on the other side, where you flip a switch and you're providing peaking power to the grid when they need it because of air conditioning, or like it happened down in Texas with the ice storm. There's just so many applications. It comes back to my engineering days. It's exciting, and it sort of bridges the gap between finance and engineering, with the Bitcoin being digital energy. That's how I describe Bitcoin. It's digital energy. And as Michael Saylor says, it's just the first law of thermodynamics. It's conservation, the principle of conservation of energy.
Well, I can't wait to eat a Bitcoin infused cucumber. That's going to be
Wouldn't it be cool? And the guy's down there. So here's another example. So I'm down there in Leamington, Ontario, and I'm talking Bitcoin. He's like, I can't afford a Bitcoin at $60,000, or at the time I was down there, it was probably like 12,000 US. And I say, dude, you don't need to hold one. Download a wallet. And within the meeting, the whole meeting switched from cucumbers and tomatoes and greenhouses to Bitcoin wallets. And and by the end of the meeting, the guy's like, I can't believe this. And he still sends me emails all the time. That 12,000 is now worth 5 times, And I'm like, yeah. And imagine if you were doing that on scale. Imagine if you were mining a bunch of Bitcoin because you had this surplus energy resource in the summertime called a jet turbine engine, which they would own. And yeah, these are exciting times for people to diversify their revenue streams. And I'll take it one step farther. Imagine if you're a gold miner in Northern Ontario and you need all this heat in the wintertime to heat your mine, but you don't need it in the summertime, but you have this turbine up there. Do you think it would make sense for a gold miner to use some of that energy, stranded energy, to mine Bitcoin? Wow. That sort of blows your mind, right? You're mining something that's a competitor to your physical gold, albeit way better, and you're diversifying your business. Do you think the first gold miner to announce that they're mining Bitcoin might blow the doors off of the community? I think it will.
Yeah, that sounds like a pretty awesome strategy.
Anyway, so many things. And again, I look, it's 12 years old, right? Like, all I'll tell you is I've seen so many things change. Some things seem like they'll never change, and then all of a sudden you hit the wall and it goes parabolic. I'm getting the feeling that the same thing's happening in a lot of parts of the industry that I'm involved in right now. The money management side, I mean, you don't have to look too much further about all these money managers that are giving Bitcoin a much more thorough review. Despite what some of the old timers are saying, like, don't bother doing it. The smart ones are doing it, right? Follow what Goldman Sachs is doing rather than what they're saying. Follow what JP Morgan is doing rather than what Jamie Dimon, CEO of JP Morgan, is saying. He's probably saying, God darn it, I hope Bitcoin doesn't succeed because I know it'll intermediate my whole business. But then on the side, he's like, hey guys, do some research because, and their research guys are saying, hey, Bitcoin is here to stay.
Yeah, that's a good point. Like, look at what they're doing, not what they're saying, because they've been shitting on Bitcoin for so long, and then an announcement after announcement's coming out lately of their desks getting set up for Bitcoin.
They have to, because they want to be captive. Like they control the foreign exchange flows and are able to really, really charge full bid offer spreads on foreign exchange flows within their system. They want to do exactly the same thing with their captive system on Bitcoin.
That's why we need to continue to get people to get wallets and even set up their own nodes and run Bitcoin and actually use Bitcoin. You don't need to use JP Morgan. Those guys are ripe for disintermediation. Yeah. And that's what Bitcoin is. So kind of like,
but don't forget, there's still a 300 billion. I think JP Morgan, the last time I looked, I might be wrong here. I wish I had it. I bet you JP Morgan is worth $300 billion, right? I think that's the market cap, if I'm not mistaken, of JP Morgan. That doesn't go away overnight. Okay. So they're going to be there, and they're going to be there, and they're going to be trying to maintain their captive system. And if JP Morgan's doing it, so are all the other banks. And if Fidelity's doing it, so are all the other money managers. And that's what happens.
So I think a good piece of advice for people we can leave off with is continue learning about Bitcoin. Get a wallet if you haven't yet, set up your Bitcoin, and there is a place for Bitcoin in your retirement account, in those dinosaur regular financial banks and everything. You know, the government gives us these tax deferred accounts and tax efficient accounts, TFSA, Roth IRA, all that stuff. So use it, but don't take too much risk. Like, don't leave more than you can afford in the traditional fiat system.
That's a great way of putting it. Don't leave more in the fiat system. And here's the flip side.
Yeah, more than you can afford to have to lose. Blown up.
Okay, so here's the flip side, though. If you own 0 Bitcoin, you're taking in a measurable amount of risk compared to if you own a proper amount of Bitcoin in your portfolio. And that means getting off 0. Anything above 0 is better, and it's lower risk than owning 0 Bitcoin right now. And if you have any questions on that subject, I'd be happy to engage either privately or publicly, but it's all about hedging your risk and then pure mathematics. This all comes down to math. It's very, very simple. You cannot argue with math.
And even if you can argue with math and you try to fight math for the next 30, 40 years, like what the modern monetary people are trying to do, maybe they win. Maybe they can like bend math's rules for 40 years. But even in that situation, Bitcoin is just going to continue to suck. So
that's
value.
It. That's the parallel universe. Like modern monetary theory, you can call it a bunch of different things, but all it is the belief that the system isn't going to call you out. It's the belief that the system will still have confidence to lend you that money. And as we've seen in the past, that confidence evaporates very quickly. Okay.
You know what it reminds me of? It actually reminds me, modern monetary, we're just thinking about this now. Modern monetary theory reminds me of the people that thought that the earth, that the sun revolved around the earth. It's like thinking math revolves around us, and we can just bend the rules of math to whatever we think.
Could very well be.
But we revolve around math. Like the rules of math are not
layer. That's the math is the base layer of language. Exactly.
So you can't just keep expanding the amount of money without people having to eventually do the calculation.
The only way you can, Brad, is that the people understand that the fiat money that they're lending you right now is going to be debased with 100% certainty, because that's the mathematics of it. And therefore you need to hedge that reality. So you mentioned real estate going up in your neighborhood. Well, real estate's a form of a hard asset. Okay. Real estate and Bitcoin. Bitcoin's a harder asset than than real estate, but real estate's a much harder asset than fiat. So is it really that real estate's going up that much, or is it that your unit of account called a fiat dollar is declining that much? And I think it's mostly the second part, that we've printed so many fiat dollars that the value of your house appears to be going up, but it's not. It's just that the value of your purchasing power of your fiat dollar is going down.
Yeah, and you can see that everywhere. You can see that in the rising prices of energy and food and entertainment.
Yeah.
So
like,
it's
just,
but it's,
as an engineer, engineers tend to be some of the first people that understand Bitcoin, because perhaps they're a little more comfortable at math than most other people. And then they understand the concept of conservation of energy and putting your store of value in something that is mathematically programmed to increase in value, rather than in fiat, which is mathematically programmed to decrease in value.
And then there will be a point too at which Bitcoin just retains its value, because really money is just, it shouldn't increase or decrease in value. It should just be purchasing power, stored purchasing power.
In a society that's growing by population and growing by GDP, and most importantly is based on a leveraged system like banking, it has to increase in value, because collateral has to increase in value in the fiat banking system, because that's how the fiat banking system works. Okay, so I will argue that it will always increase in value. And the other flip side is, why will it always increase in value? Because fiat will always decrease in value, provided the fiat game continues. But what if it stops? What if one country failing causes a domino to another country failing, causes counterparty risk? Man, oh man, I don't actually want to be alive for that. Except that the risks are increasing on a daily basis.
I mean, I more so meant that, like, there's going to be a point of market efficiency or whatever, where the value of a store of value like Bitcoin is priced properly in the marketplace.
I guess what it is one Bitcoin equals one Bitcoin, and you know, that's what it is. That's a unit of account, right? If Bitcoin.
80% of the world is using Bitcoin, then I'm sure one Bitcoin equals one Bitcoin, but it'll probably equal $10 million.
Oh, easily. Well, it's actually that's a low price if that's the case, and we can run through that math at a different time. But it's just, you got to do your math, and then you got to do your expected value outcomes, run probabilities on it, and then be comfortable. I did something.
There's a good comment from
Count Bitcoin, and an limited amount of fiat work, if you just believe. So see, here's what I want to say.
Peter Pan syndrome, the modern monetary theaters. Modern monetary theater, that's a good name for it. Modern monetary theory is Peter Pan syndrome.
Yeah.
Unlimited amount of fiat will work if you just believe.
So here's the thing, and this is based on my work on the CDS market. I believe today that Bitcoin is worth between 110,000 US and 160,000 US per coin, based on credit default swaps spreads today. All that CDS spreads are going to do going forward is increase in value, and that will increase the intrinsic value of Bitcoin using my model. It doesn't mean my model's better than anybody else's model out there. It just relates Bitcoin back to something I've traded for 30 years. And the really cool thing is, it is got no counterparty risk. It's not like I'm purchasing this default protection from Bear Stearns and I'm purchasing it on Lehman Brothers. Oh my God, but Bear Stearns is also suffering the potential default scenario. So that value of that insurance isn't valuable if your insurance provider is about to default as well, right? So look, Bitcoin is the most beautiful thing I've seen in 30 years. It's the best asymmetric trade I have seen in 30 years. Am I 100% certain? No, you can't be 100% certain about very much these days, but based on a probability analysis, it is so cheap right now on a number of metrics.
So I was planning on wrapping it up, but I got one more comment came in from someone, my neighbor Eric. Actually, he said this is a good topic to touch before we wrap it up. What do you think the likelihood of fiat money going back to a gold-backed system, or maybe a gold and Bitcoin-backed system, but specifically gold, because that's what's been money for 5,000 years,
right?
We've only been off the gold standard for like something like 50 years in terms of the US.
Yes.
What do you think that likelihood of that happening is?
So I actually think it's low. It's not zero. I'm not going to be like Peter Schiff and say, oh, Bitcoin, I'm 100% Bitcoin. I'm Peter Schiff. I'm 100% certain Bitcoin's going to zero. I'm not going to be, I'm 100% certain that the world will never go back to the gold standard, but I am going to say it's a very low probability in my estimation. And if the world was actually smart, it would go to the Bitcoin standard. Call it digital gold. I like to call it digital energy, but I would say it's a higher probability that it goes to a Bitcoin standard than back to a gold standard. That's my bias. Both of them are very low probabilities, but for the benefit of my kids, I would hope they chose one or the other, because the current system is guaranteed to fail over time.
There was an interesting thought experiment that I saw on Real Vision recently. I can't remember exactly who it was that said this, but they said that there was one more weapon in the central banker tool belt that they could pull out, which is to take all the gold in Fort Knox, mark it up like 10x, and then make it back, like re-back the dollar to gold with a much higher price markup.
Yeah. Okay. So what does that mean? That's just the same way as saying mark your fiat down 10x. I mean, it's exactly the same thing. So yes, it would work, because that's where we're heading. Your fiat is going to be debased 10x times. I say that you can lose half of your value an infinite number of times. That's mathematics as well, right? You can lose half of your value an infinite number of times. That's mathematics as well. So yeah, okay, that works, because it's just the other way of saying, okay, I'm marking my fiat down 10 times. Same thing, same argument, smoke and mirrors.
Yeah, the problem is that all the countries need to kind of do the same thing.
Or they don't. And the first mover is going to be the winner.
Yeah.
And that's where game theory comes in. And that's why I wish that we got the ear of our local politician like Pierre Poilievre or Poilievre. I wish I could remember his last name, but the man is so close to getting it. And look, it won't take much. And there will be a nation that comes out and says they own Bitcoin, and it will start the arms race, the quote unquote arms race, but it'll be called the Bitcoin race.
Well, we got Jeff Booth on our side. Lovely Canadian.
I love that man. His book is probably the best book I've read easily in the last 10 years. Okay.
He said that he's recently gone to the government of Canada, and he's talked to them at the Senate or the budget committee or something like that.
Okay.
And so he kind of has the back channel to some people in government.
Yeah.
And he's helping them get orange pilled, some of them.
Oh, listen, that would be great for my kids. I've talked to Jeff when I was in Vancouver this year. His work is amazing. He's obviously a big thinker. And not only that, he's done it, right? Here's the thing. A lot of academics talk a big game, but they've actually never traded risk or actually managed risk. Whereas Jeff Booth has started a number of companies, which when he started builddirect.com or something, the equivalent of Home Depot Supply. The guy has done it. He's not a pretender. He's a doer. And we need to listen to people like that. That's what makes Canada have a fighting chance.
All right. Well, on that note, man, that's been a great conversation.
It's been long, eh? 2 hours and 20. I think that if anyone's still listening, I want to thank everybody for their, I love Bitcoin Twitter. Brad, you've done an amazing job getting people educated in Canada. I really am flattered to be on your show, but I'm also I want to applaud you for the risk that you're taking in various capacities to help out the future for our future generations. So whether it was investing in 3IQ, whether it was giving out, at Halloween, giving out those Bitcoin cards, you need to take that video. You need to show it to the government. And look, videos speak for themselves. It's coming. We can either be a part of it or we can be ushered aside as a insignificant player. But Bitcoin at $60,000 is a rounding error. Anybody who's trying to split hairs and say whether Bitcoin's worth 60,000 or 25,000 or 75,000, You're missing the big picture. You're overthinking it.
Awesome. I love
Thank
that
you.
message.
Thank
What's
you.
the best way that people can get you? What are you, Greg F. Foss on?
Yeah, I'm at Foss, Greg Foss. So at FOSS, on Twitter. DM me. I've received tons of beautiful feedback. I have a paper. I'd be happy to share that paper with you. It was just published in Bitcoin Magazine last week.
Nice.
Yeah, it's getting some really good. I'm talking to the Canadian Bond Investors Association on that subject in the upcoming. I know a lot of people on Bay Street, obviously, from my career. I'll just tell you, I have conviction in this as the best trade I've seen, and I'm trying to share that knowledge, not because I'm the smartest man in the room, only because I believe it's a different way of looking at it that a lot of people haven't considered.
Awesome. Well, follow Greg on Twitter. He's
Thanks,
got some
Brad.
great posts, and you've been on Peter McCormick's podcast, and I think
have
Marty Bent's podcast.
John Vallis. I was just Preston Pish. We drop on Wednesday.
Oh, awesome! I can't wait to hear that one. So
thanks, buddy. Yeah, you know what?
That's awesome, man. Well, I gotta have you guys. We're gonna have like a big roundtable, an energy roundtable or something.
Here's one other thing. What I'd love to do. Somebody in Canada needs to organize the Canadian Bitcoin influencers or whatever, of which you can be front and center because you have a great following. But even NVK and all these guys that are just underappreciated, even in our own backyard, they're sort of appreciated on a global stage, but in our own backyard, like we have this massive resource of Bitcoiners that really aren't appreciated in Canada. And yeah, I'd be 100% on that. I love supporting. I do contribute to the Bitcoin core developers. I think that we have an opportunity to really change the narrative in Canada, especially with our natural energy resources. So thanks again.
Yeah, that's a good idea. We do have a lot of people that are in Canada. A lot of
crazy.
People in Canada.
We punch above our weight on that one stage. Sort of like hockey, man. We're okay in hockey, and we're okay in Bitcoin as well.
Right on, man. All right. Thanks for the chat.
Thank you so much. Really appreciate it.
Bye-bye.
Take it easy, Brad. Thank you.